Joining us right now for a closer look at how coronavirus is impacting the U.S. economy, let's welcome Daniel Tarullo. He's a former Federal Reserve governor who's now a Harvard law professor. And thank you for being with us today. We appreciate it, Governor Tarullo. What do you think of the numbers that we just saw? What do you think of the numbers we just saw? 6.6 million new additional jobless claims after the 3.3 we saw last week. That's an incredible number.
Well, Becky, my first reaction was back in early 2009 when we were seeing 600,000 increase in unemployment. Now, we're talking jobless claims here rather than unemployment. But when you see numbers that are of that order of magnitude, it becomes clear just how steep a decline we are suffering right now, and there's really no precedent for thinking about this. A number of your commentators and guests have said that over the past few minutes, and I think that what it really does is to reinforce the sense of a lot of people that the prospect of a V-shaped motion here with going down rapidly and then coming up rapidly may unfortunately not turn out to be what we see, and instead we'll face a much tougher road back.
Why do you think that is? How do you start to think through the damage that we're seeing at this point?
Well, obviously nobody knows, and the uncertainty is something that everybody in markets and government is emphasizing. But first, as I said a moment ago, there really is no precedent for essentially shutting down sectors of the economy with the attendant damage that may be harder to undo. It's not like laying off a quarter of your workforce because revenue has dropped by a quarter. This is going to zero revenue. Second, I think there's the possibility, if not the probability, that we're going to have recurring preventive measures, such as some form of social distancing, which will mean hitting the brakes. Maybe not, certainly not, we hope, the way it's being done nationwide right now, but hitting the brakes in certain areas, certain regions, certain sectors, perhaps for some time to come. Third, the monetary and fiscal policy instruments that are available to us are going to be stretched. They are already being stretched to the limit, and thus they may be less successful, not unsuccessful, but less successful in effecting a quick bounce back. And finally, there's the question as to whether some of the longer-term trends in the economy, such as declining productivity, will be accelerated by this kind of shock. You recall after the great financial crisis when people kept referring to headwinds that were stopping the economy from getting back to pre-crisis trend growth. And after a while, people realized maybe they weren't just headwinds that were going to abate, but that it was an indefinite decrease in growth potential. And there may be something like that here as well. So again, I wouldn't argue strongly that the likely outcome is going to be a long, slow, painful recovery, but I think it's just as much a chance as something resembling a V-shaped recovery.
You know, the declining productivity, that's like third derivative stuff, trying to think through everything we care about right now and how we're trying to face the immediate problems. But that's a really good point. Productivity is going to be a challenge, I would assume.
Yeah, it will be a challenge, and you're quite right to say it's a continuing problem, and it's not something that people can or should be focusing on now. People now should be focusing on the best possible response in human terms and in health terms and in economic terms. I mention that only as a contributing reason why the recovery may be more disappointing than, at least initially, a lot of analysts seem to think it would be.
Steve Leisman has a question as well. Steve?
Thanks, Becky. Yeah, Dan, in your last incarnation at the Fed, you were involved in all the banking regulations. Many of the big banks have voluntarily stopped share buybacks. Should the Fed have a blanket order on stopping share buybacks, and should it end bank dividends right now, in your opinion?
For the CCAR banks, Steve, that is to say the larger banks, the ones over $100 billion that are stress tested, I think the answer is yes. I mean, it's a good thing that going into this crisis, the banks in the United States are a source of strength rather than a source of vulnerability. But as we've all been emphasizing, there's enormous uncertainty here as to how much deeper and longer what's going to be a serious recession at best is going to be. And it's right out of the playbook, really, at this point, that you would have banks husband their capital. If about a third of the capital distributed by the larger banks last year was in the form of dividends. And again, we hope that it's not going to be needed, that capital, to absorb losses and to increase balance sheets, but it may be. And I think it's best to do it now while the banks are still in a position of strength, precisely so that it doesn't send a signal about any one bank or the industry being collectively weak. And so I think it is important. The Fed has the authority to do it.
Dan?
And as I say, it's right out of the playbook that people tried to write after the crisis when some banks were giving dividends in 2008.
Dan, without getting too much into the weeds of bank regulation, do you think the Fed should also ease up on some of the capital and leverage ratios that would allow the banks to play a bigger role now? And we know they already did the supplementary leverage ratio, but without getting into the weeds here, is it possible for the Fed and the bank regulators to ease up on those regulations that would allow the banks to play a bigger role in easing the strains on in the credit markets without the Fed having to do more?
It may well be, Steve. I mean, the Fed's balance sheet obviously is growing enormously, and that means the quantity of reserves in the economy is growing enormously, and thus bank balance sheets would be expected to grow. The question, though, I think, is how one does it, and I think to the degree possible, one would want to provide relief on things like the leverage ratio or the liquidity coverage ratio in a way that is tied directly to the Fed programs, the Fed facilities, the kinds of mechanisms that it is using. And that will both reemphasize the temporary quality of deviation so that you have debates about long-term policy when things are calmer, and it will provide the needed relief. But at the same time, I come back to the point of a moment ago, you need to make sure the banks actually do have enough capital during this period. So I would have packaged these things. I would have said, yes, we may need some relief precisely because of these balance sheet effects, and the Fed facilities are obviously going to be providing more assurance than external lending, but let's make sure that the banks are keeping their capital in the event that this turns out to be closer to the tail than to the modal expectations.
Hey, Governor Tarullo, you do think, though, that the stress test for the banks should be put off, correct? I mean, I guess this is enough of a stress test itself, what we're seeing. Yeah,
Becky, I think there are reasonable arguments on both sides when it comes to the stress test, but that is continuing it now. It sort of shows that, yes, it's regular and we do it. But I think on balance, I would defer it. I'd defer it because the scenario that's being used now is obviously not going to approximate even closely what the banks are actually going to go through. It's not the same kind of stress. It's probably not the same level of stress. I think it would be a good thing for the risk managers at the banks to be thinking very hard about this set of stresses and crises rather than worrying about whether the stress test is going to come out a particular way based on the scenario. So, yeah, on balance, I would delay it and have both the people at the Fed and in the banks who focus like a laser beam on the problems that may be encountered as a result of what we're going through right now, keep the capital in the banks, and then later in the year, once hopefully things have calmed a bit, return to the stress test. Maybe they want to use the same scenario if things have really calmed down, maybe a different one.